Welcome back. Last video on Module 6. Need to finish up, or I'm going to go back and talk about what I was speaking on. We were just talking about depreciation methods that are allowable under GAAP. I had mentioned straight line, units of production, accelerated methods. One of them I mentioned was called double declining balance. And then there's one for tax purposes, which is where I got cut off. But for tax purposes, you can use MAKERS, which is your modified accelerated cost recovery system, and that's just a faster way. That's a accelerated method for taking depreciation for tax basis purposes. The other three, straight line, units of production, and double declining balance that I mentioned, those are all allowable for financial reporting purposes. So yes, there is a difference between what happens related to tax return information for depreciation and what happens on the financial statement for depreciation. Moving on, depreciation expense. Let's talk a little bit about that. It's an expense account, shows up on the income statement. It's the amount or a way that we reflect how the usefulness of an asset has gone away. And depreciation expense is a current period item. Now, you heard me mention earlier also something called accumulated depreciation. That is a balance sheet account, and what it reflects is the total of all depreciation expense that's been taken on an asset. So in the current period, you would take depreciation expense, and that would show up on the income statement. In the current period, related to that depreciation expense, we also make a credit. And that's getting to some accounting stuff there, but we also have this account called accumulated depreciation, and it's going to total up all of the depreciation expense that's ever been taken, and it will go to help us value the asset at book value on the balance sheet. Now, property, plant, and equipment can have what's called impairments. So we have these long-lived assets like a piece of equipment or a building, something of that nature. It's expected to last a long time, but because it does last a long time, sometimes it can have an impairment, meaning that it's not expected to produce benefits as it did before. So an impairment, if an asset gets impaired, we say that we have to write it down to its correct value. Now, we're not going to go into that calculation, but just realize long-lived assets in property, plant, and equipment can be written down, and we call that an impairment. Now, a couple of formulas I want to talk about related to property, plant, and equipment. And this is where most people seem to have some issues related to this chapter on figuring out the problems. Relates to property, plant, and equipment turnover and let's do property, plant, and equipment first. Most people do this one okay. It's just a relation, it just shows productivity. But that is where we take sales, our net sales, divided by our average property, plant, and equipment net assets. So we're just taking that book value amount, which is cost minus accumulated depreciation. So again, it's sales minus the average of the net value of the assets. Now the goal of that is to see that we produce more sales for the assets that we have employed. So you want the turnover number to be high, a larger number, meaning that you're having more sales for the assets that you're using. Now, where some of the calculations get a little tough relate to the average useful life and a percent used up. And the thing that you have to watch here is those formulas only use depreciable assets. Okay, so land, things that don't get depreciated, you have to subtract that out of the value and come up with this depreciable asset cost. Out of time, I'll make that the end of the video.